This is Nightly Business Report with Tyler Matheson and Sue Herrera.
Fizzling finish. The Federal Reserve's number 2 signaled it may be a September to remember for interest rates, and that took the wind out of stocks. Sprinting higher. His fund is up 25% this year, easily outperforming the market. Find out what stocks our Market Monitor is buying now. Budding opportunity. Why startups, usually associated with Silicon Valley, are turning to one of the oldest of professions, farming. Those stories and more tonight on Nightly Business Report for Friday, August 26th. Good evening, everyone. I'm Sue Herrera. Tyler Matheson is off tonight. The door is open to an interest rate hike. The head of the world's most powerful central bank says the labor market is solid, and so is the outlook for economic activity and inflation. That, according to Janet Yellen, means the case for a rate rise has strengthened in recent months. But as she usually does, Ms. Yellen hedged her comments in such a way that nothing is definite. And investors seem to like that, sending stocks higher after she spoke this morning in Jackson Hole. But then her number 2, Vice Chair Stanley Fischer, was a little more direct and said that Yellen's comments were consistent with a possible September rate hike. And that changed the mood. Stocks reversed course, and the gains of the morning were gone. When all was said and done, the Dow Jones Industrial Average lost 53 points to 18,395. The Nasdaq added 6, and the S&P 500 was off 3. Steve Leisman reports tonight from the annual meeting of central bankers in Jackson Hole, Wyoming.
After taking in the vista at the foot of the Grand Tetons in Jackson Hole, Federal Reserve Chair Janet Yellen took to the podium at the Fed's annual meeting and suggested the Fed is perhaps ready to raise interest rates. She said in her speech, in light of the continued solid performance of the labor market and our outlook for economic activity and inflation, I believe the case for an increase in the federal funds rate has strengthened in recent months. Of course, our decisions always depend on the degree to which incoming data continue to confirm the committee's outlook. Even though today's GDP report showed sluggish growth just above 1%, Federal Reserve Vice Chairman Stanley Fischer, in an exclusive CNBC interview, dismissed GDP as a backward-looking measure and echoed Yellen that the U.S. economy is reaching maximum employment.
We want to be looking ahead when we make this decision, not back. We're reasonably close to what is thought of as full employment, and inflation rate this year is higher than last year's. It's still not up to 2%, but it's been growing. So you ask, what are the big numbers we look at? The big numbers are better than they have been for some time. And then we're getting some feedback, some reinforcements from what's been happening on a monthly basis.
Asked if markets should prepare for a possible September hike and maybe 2 this year, Fischer said yes, if the data cooperate. Next week's August jobs report will be critical to the rate hike case for the Fed. Barring any signs of weakness in the data, Cleveland Fed President and FOMC voting member Loretta Mester also left the September rate hike on the table, suggesting growth could rise from 1% to 3% in this year's final 2 quarters.
I think we'll have some strengthening in the second half of the year, yes. I think the economy is on a good track. I think the employment numbers show that. I think the inflation numbers are coming up slowly. They're below our target still, but they're moving in the right direction.
Among the gathered Fed officials, there seemed fairly good agreement that rate hikes were near, but also that rate hikes would be gradual. For Nightly Business Report, I'm Steve Leisman, Jackson Hole.
More now on the gross domestic product report that Steve just mentioned. Overall, economic growth for the second quarter was trimmed to just a bit more than 1%, but a key measure of corporate profits rose for a second straight quarter. The report also showed that personal consumption rebounded sharply, but that business investment remains soft. Americans are not feeling as optimistic about their finances. A gauge of consumer sentiment posted its 3rd straight monthly decline. According to the University of Michigan, the index fell to its lowest level since April. Consumer sentiment had been supported by steady hiring, lower interest rates, and the declining price of gas. And although gas prices are still relatively low, they've started to inch higher following the path of oil, which has gained 10% during the past month. But whether crude continues to make gains depends mostly on what happens in countries halfway around the world. Jackie DeAngelis takes a look at the global flashpoints.
The recent move higher in crude oil prices comes from the belief that there may be supply constraints in the second half of the year, but that may be based more on fear than fact. According to OPEC's latest monthly report, Iraqi production is more than 4 million barrels a day and slowly increasing. That's up nearly 1 million since 2014, when oil prices traded around $100. Iran's production is more than 3 million barrels and close to pre-sanction peaks. Libya is producing about 300,000 barrels a day. Maintenance on key export facilities there suggests that numbers could be on the rise shortly. Nigeria has been a big concern. Production is about 1.5 million barrels per day, but a recent ceasefire in the region bringing some optimism back for that country too. Venezuela could be the biggest wild card. It's producing just over 2 million barrels a day, but could see shortfalls as turmoil continues with little relief in sight. The takeaway here? The trouble spots don't appear to be that stressed, which could mean the oil glut will continue to weigh on prices into the second half of the year. Or the situation creates more incentive for OPEC producers to cooperate and implement a freeze at their upcoming meeting in late September.
If they do a freeze, they're at max capacity. We're coming off. The reason why is they're at max capacity. They're producing a lot of output. It allows for a lot of producers in the U.S. to now start producing because a stabilized price of crude oil higher up. They now start producing quite a bit of crude oil. We now have even a bigger glut than when we started with. Very short term, I'm bullish, but longer term, I'm very bearish. And I think we're going to see the mid-30s within the next several months.
For the moment, oil is range-bound, stuck between $45 and $50 a barrel. But industry insiders say a big move is coming. They're split, however, on which way it will take the market. For Nightly Business Report, I'm Jackie DeAngelis.
Still ahead, our market monitor tonight has a hot hand. His fund is up 25% this year. And tonight, he's sharing a few stock recommendations. New funding for Amtrak's Northeast Corridor. Vice President Joe Biden said the government will make a nearly $2.5 billion loan to Amtrak to buy new trains and upgrade tracks. The Department of Transportation is making the loan, which it says is the largest single loan in its history. It has been a long haul for the trucking industry this year. The sector has hit a number of bumps in the road, including new regulations and weak economic growth. But there's one big bright spot, and that caught the attention of executives from the biggest fleets in North America at the Great American Trucking Show. Morgan Brennan reports tonight from Dallas.
Every August, 30,000 people descend upon Dallas for one of the biggest trucker conventions of the year. In 2015, U.S. truckers hauled more than 10 billion tons of freight, representing a record $700 billion in revenue. But what a difference a year makes. In 2016 so far, truck tonnage has tumbled, thanks to high inventory levels, low commodity prices, and weak economic growth. Making matters worse, many companies had expanded their fleets, meaning there are too many trucks for too little demand.
Companies are going to see less utilization, fewer miles, they're going to get paid less for those miles, and their expenses are still up. So it's going to be lower margins, it's going to be lower profitability, lower earnings for the publicly traded carriers.
But there are bright spots. E-commerce continues to surge, representing a huge growth opportunity for companies like Covenant Transportation Group.
It's our fastest growing segment of our total business. We're doing about $750 million a year revenue, and it's about 30% all related to e-commerce. That number has basically been going up about 50% a year.
As Amazon and other e-tailers ship more products, newer players are entering the package delivery market as well. Take Transforce, a top Canadian trucking and logistics firm that's rapidly expanding its U.S. presence.
We have one customer that just 18 months ago, we were basically doing nothing with those guys. And today, if we look at the statistic of what we've been doing today for this same customer, we will probably do more than 35,000 deliveries.
And consumers increasingly want goods immediately. That pressure to deliver to doorsteps faster is spurring the adoption of new technologies to gather data, monitor weather patterns, and make the business more efficient and safer. But all the technology in the world can't help the industry's most pressing need: new hires.
Drivers are the #1 challenge, and it continues to be. I mean, the age continues to get older, and you don't have as many of the youth coming in. A lot of the millennials are not wanting to drive trucks, and so we got to figure that out.
And that makes trucking conventions like this one all the more important. For Nightly Business Report, I'm Morgan Brennan in Dallas, Texas.
Herbalife is caught in the middle of 2 billionaire investors again. And that's where we begin tonight's market focus. Late today, billionaire investor Carl Icahn said he purchased another 2 million shares of Herbalife, and that he never gave an investment bank in order to sell any of his stake. But that's contrary to earlier reports that indicated Icahn was considering a sale to a group that includes fellow hedge fund manager Bill Ackman, who has a big short position in the company. So shares of Herbalife rose initially in after-hours trading following the Icahn statement. The stock fell, though, during the regular session on the earlier reports. The mega merger between beer makers Anheuser-Busch, InBev, and SAB Miller is expected to result in job losses. Anheuser said about 3% of the new company's total workforce may be laid off in the 3 years following the acquisition. Shares were down marginally to $125.74. Cloud company Rackspace is going private. Apollo Global Management will buy the company for about $4 billion. The offer represents a premium of about 38% to the company's closing price on August 3rd, which was the day before reports surfaced of a potential transaction. Rackspace shares rose 4% to $31.50. And Big Lots saw profits rise more than expected in the latest quarter, prompting the discount retailer to raise its guidance on earnings for the year. But sales disappointed as fewer stores in operation hurt results, and the company also said same-store sales are expected to grow in the low single digits for the year. So as a result, shares fell nearly 4.5% to $50.57. Our market monitor guest tonight likes stocks that he says are undervalued. Last time he was on in January, he recommended EnLink Midstream, which is up 62%, La Quinta, which gained 6%, and Spirit Airlines, which is 11% lower. Joining us tonight, Craig Hodges, portfolio manager of the Hodges Fund, which is up 25% so far this year. Welcome. Nice to have you here.
Thank you, Sue. Good being on.
And congratulations on the stellar results for the fund.
Well, thank you. We've got to make sure we cross the finish line, though.
I know. This is the hardest part of the year, right?
That's right. That's right.
Let's start, first of all, with the news of the day, and that is the Federal Reserve, and specifically the statements from not only Stanley Fischer, the second in command, but also Ms. Yellen, which the market interpreted as indicating that a September rate hike may be on the table once again. What did you think of her remarks?
You know, I think everyone is kind of coming to the same conclusion, is that they're waiting for the proper data in order to raise rates. They want to do it. They've signaled they need to do it. You know, I don't think there's a political motivation to do it before the election or after. I think once they have the data that backs up what they can do, they'll do it. Now, I think they've had that a couple times, but then if you remember, like a year ago, you had the Chinese situation, then you had, you know, a couple of, you know,
Brexit,
European things
like
go. Yeah, Brexit's another great example. So, you know, I think if nothing bad happens, as far as that's concerned, and then they have the data they want, I think it's coming. But I don't think the market is that obsessed with it anymore. I think everyone knows it's going to happen. You know, you may have a 10-day or 2-week upset market one way or the other, but it's factored in, I believe, at this point.
One analyst I talked to today said he has Fed fatigue. He's just putting it to the side right now.
Yep.
You mentioned data. The GDP data came in a little weaker than most people were expecting. What did you make of that? And do you get the sense that the economy is as strong as some people think it is?
You know, no, I don't think it's particularly strong. At Hodges Capital, we do about 3,000 company touches a year. That's everything from listening to conference calls to personal management visits to them coming to our office. So we really do, amongst our 7 analysts and 3 portfolio managers, have a real feel for how companies are kind of saying how things are. And it's good, but not great. And, you know, there's slight growth, but it could be a whole lot better. So it kind of tells you a little bit about the market. I don't think the market's incredibly expensive, but it's not incredibly cheap either. So you have to almost be a stock picker. You have to look amongst the individual stocks and find the ones that are growing, that aren't expensive. And that's what we try to do.
Yeah, and we'll get to your picks in just a minute. But back to the market briefly. Before we do that, you know, you said it's not incredibly cheap, but it's not incredibly expensive. It still seems to me, though, that it's basically the only alternative globally if you want to invest if you want to invest in equities. We're still, you know, probably the safest and best place to invest from overseas.
I think you hit the nail right on the head. There's not a lot of alternatives. And, you know, you've had 7 years of money coming out of U.S. stocks and into bond and bond funds. I mean, that's unprecedented. And at some point, rates will go up, and I believe that money will come back out of bonds. Where can it go? There aren't that many alternatives. You've heard the acronym TINA, T-I-N-A, for there is no alternative. So stocks are kind of the only game in town. And I think what you'll see over the next 3 to 5 years is money coming out of bonds, trying to find a home, and really U.S. large cap, you know, inexpensive dividend-paying stocks are where I believe that money will find a home.
Well, you gave us 3 picks, and as we said in your introduction, you like to find stocks that you feel are undervalued. S Concrete, a company I'm not all that familiar with, was one of your picks. Why do you like it?
Yeah, U.S. Concrete, it's not a big company, but they're in great markets. They're about 40% in Texas. They've got about 20% of their business in New York and New Jersey. They're doing the ready mix work for the airport there, and then in the kind of the San Francisco area. But this is a business that has extremely high barriers of entry. The stock's down from the mid-70s down to around the mid-50s, but they've got a big future. Like I mentioned, they've got limited competition, and they were hurt by some short-term weather issues in Texas. That's, you know, more or less not a big deal. They will make that business up. So I can see that stock going back into the high 70s this year, and then, you know, a couple years out, it could be a $100 stock.
Let me tell you, if they're doing the cement work for LaGuardia Airport, they're going to be busy for a while. Trust me.
They are. They're in some great markets.
JCPenney is next on the list.
Yeah, JCPenney's, people don't get that excited about it, but I'm telling you, it's one of the best turnaround stories I've ever come across in my 30 years. They had the bad management group, 3 or 4 years ago that just almost wrecked the company, almost bankrupted. This new group, a lot of them are from Home Depot, are doing a fantastic job of getting the business turned around. We see them earning about $1 billion of EBITDA this year. We think earnings could get to the $1.80, $2 a share within a couple years. So the stock around $10 or actually below that, we think could go into the 20s.
Okay.
And the encouraging thing is they don't have to have a big increase in sales in order to do that. They've got this low-hanging fruit of just fixing the stuff that the last management group messed up so bad.
Let me go on in the last 30 seconds that we have to Wisdom Tree.
Yes, it's basically the largest independent ETF, and it's been obvious how big the ETF business has become. And we think this company is probably a likely acquisition candidate. The stock's come from the mid-20s down to around 10. There's been some insider buying, and probably be acquired at some point.
All right, on that note, Craig, thank you so much for joining us today.
Happy to be on. Thank you.
Craig Hodges, have a great weekend. Coming up, Betting the Farm. You'll never guess what high-tech innovations are cropping up on America's farms. Silicon Valley startup Theranos plans to appeal a decision made by regulators last month that barred its CEO from running the company for 2 years. The Centers for Medicare and Medicaid Services last month also said it would revoke the company's license to operate a lab in California. The blood testing company late last night filed its intent to appeal. The family farm looks a lot different today than it did just a few years ago. Technology is making them more efficient as farmers look for ways to produce higher yields. Aditi Roy is in Salinas, California, where farmers are sowing the seeds of innovation.
The rumble of equipment trolling through the fields is a familiar sight on America's farms. But here in Salinas, California, just an hour south of Silicon Valley, this is the sound of innovation. The machine is a water jet knife, spouting razor-like streams of water to snip heads of lettuce. The cutting-edge technology is part of Taylor Farms' dedication to innovation, which includes lasers to remove impurities from their salad mixes and robots to pack produce.
Innovation has been very helpful to be helping people become more efficient. It lets us pay them more, makes for a better job for them, and better results for us.
Third-generation farmer Bruce Taylor is the founder and CEO of Taylor Farms, which isn't just using technology, it's investing in it. The company's headquarters houses an incubator run by the Western Growers Association. 15 startups are there now. One of them, Harvestport, known as the Airbnb of farm equipment. It lets farmers rent out their equipment so they don't sit idle. Tim Coity founded the startup.
Here in the United States alone, on the shared economy narrative, at any given time, there's upwards of $6 billion of capital equipment sitting idle. So there's huge opportunities here in agriculture.
The ag tech industry is flourishing, with 307 deals and $1.8 billion invested already this year in the sector. The number of investors has risen 52%. Some of them are farmers.
If we can collaborate, we can move the needle faster. We can come up with innovations, get it implemented, and get the benefit sooner. And the benefits, of course, are using less water, using fewer pesticides, fewer herbicides, and using less labor to get higher yields.
But there are barriers, with some farmers still hesitant to adopt new technology. But the numbers could be on the upswing, with the American Farm Bureau reporting that 75% of farmers say they plan on investing in technology in the next 3 years. For the Nightly Business Report, I'm Aditi Roy in Salinas, California.
It is the busy summer holiday travel season, with many vacationers making trips around the world. And despite terrorist attacks and economic slowdowns in some countries, tourism is still expected to grow and grow more than forecast. Susan Lee tells us where travelers are headed.
Travel and tourism is a big contributor to global economies, adding over $7 trillion to global GDP, employing 1 in 11 people on the planet. The busy summer travel months are crucial to the industry, and in 2016, some places are more popular than others. South Asia is a standout, being driven by interest in India's economic prospects, drawing in the visitor numbers. Elsewhere, despite all the headlines of slowing growth, China is still attracting holidaymakers to Northeast Asia, with China tourism growing at a strong pace of over 6%. Tourism to Southeast Asia growing at 4%. Asia as a whole has really benefited from their weaker currencies versus the strong U.S. dollar. North America is also performing well so far, expecting to grow over 3% this year. Experts say that the technology revolution is another big factor fueling the travel trend.
Companies that are really ahead of the curve, they're really doing an amazing job in democratizing travel, creating platforms and experiences and tools that really help the consumer go to places that they would have never really imagined.
So where are travelers avoiding? Tourism to Brazil is still expected to contract this year, and Latin America as a whole is also expected to see falling travel. Concerns over the Zika outbreak is another factor deterring tourists. Europe is still suffering terrorist attacks in Paris, Nice, and Brussels have scared away travelers, with the world's biggest tourist destination, Paris, reporting a big drop of over 9% so far in 2016. Business is suffering so much in the City of Lights that 4- and 5-star hotels have cut their rates by as much as 45%. Also suffering from terrorism is Turkey. Terrorist attacks, along with headlines of a failed coup and the country's proximity to the Syrian border, have dampened tourist interest. And what about the impact from Brexit, the much talked about UK vote to leave the European Union? Brexit has not had an impact, with the UK holding up as a travel destination in 2016. The weaker currency has made the country a more attractive tourist spot. Welcome news for the country's new government and its economy. For Nightly Business Reports, I'm Susan Lee.
And that is Nightly Business Report for tonight. I'm Sue Herrera. Thanks so much for joining us. We want to remind you that this is the time of year your public television station seeks your support, and we appreciate that support. Have a great weekend, everybody. We'll see you on Monday.